Welcome back to the All in Stocks Conversations. My guest today is Gary Mishuris of Silver Ring Valley Partners. I've met Gary 1 year ago, and for that long, I've been wanting to have him on the show. He has a very methodical approach to value investing, and I think you're going to like him. If you want to gain access to all my work, head over to allinstocks.com. For the price of two mojitos, you can gain access to all my top picks. And remember, I have a 30-day money back guarantee, so it's risk-free for you. So let's go to Gary now. Hi, Gary. Thank you very much for being here. I don't think you remember, but I first got to know you through LinkedIn when you posted a post about how you spotted a fraud, and that got me interested. And then I started following you. And one day you were looking for people wanting to grow through your internship. And previously I was an architect before becoming an investor, and I had gone through an internship in a big, well-known office, and it was an unpaid internship like yours, and it was a bad experience for me. And I must say, in the architectural world, there's a lot of big names that take advantage of young people, and it's a terrible exploitation. So I was really upset when I read your post, and I replied to it in a toxic manner. And today I'm not going to say I regret it, because if it were not for that, we wouldn't be here today. And then I was kind of very interested on your reply, and you told me, don't jump into conclusions without having all the facts. And you told me as well that your former interns were very happy, and they all said that they were getting more value than what they were giving. So I was like, maybe this is interesting. I want to learn or accelerate my learning. And you mentioned, if it were me, I would jump right into this opportunity. And I decided, okay, let's give it a try. And so here we are after 1 year, more or less. Thank you. Thank you very much. Without that internship, I wouldn't be the investor I am today. I'm not saying that I'm a great investor, but I would be much worse than I am today. I've learned a lot from you. And for those people who are trying to or looking to improve their skills and improve their knowledge, I'm not sure if you're still looking for new interns, but I highly recommend to get in touch with you and apply for it, because it's one of the best trainings I've had so far. Thank you,
Well,
Gary.
th- well, thank you for the kind words. And I do remember how we started. I At first I read your comment and I was like, "Wow, this guy is pretty aggressive, and he doesn't even know me. Like what did I do to him?" But I am glad that I decided to give you a fair chance. And I was actually in one of my kind of cycles where I was assessing potential interns, and I usually work between 1 and 3. And so I said, you know what? When you applied, I'm gonna ignore what you wrote because I'm just gonna evaluate you like I evaluate any other candidate. And if you make it, great. And then you did make it, which most people don't. Most people who apply, they want to learn, but they don't have the ability to contribute, so it just doesn't work out at that point in time. So I enjoyed our year, and I'm happy to be here. And ask away. Tell me what we can talk about.
I wanted, first of all, for the audience, most of the audience, and I probably, now that I'm inviting you, that I'm having you on, I probably will reach out to a larger audience, but mostly it's Portuguese people, and
Mhm.
they're probably not aware of your story. I would love to hear your story, where you come from, and how you got to where you are today.
Sure. Well, I'm an immigrant to the United States, which is where I live now. I grew up in Russia as a kid. We immigrated in 1989 before the fall of the Soviet Union. Spent actually a few weeks in Austria, then 5 months in Italy, a little town called Ladispoli, about 45 minutes outside of Rome. So then came to New York and kind of, was pretty poor. My father passed away at an early age. It was my mother, my grandmother, and I. My mother got a job, and pretty early on, I saw her start researching mutual funds as a place to invest her fairly small savings, and so I always think of my mom as kind of that person who is middle class. We were no longer poor because she did have a good, well-paying job, but it wasn't like we were well off or anything. And as a single parent, it's not that easy, even with a job. And so I remember her caring a lot about where the money goes and how it's going to get invested. So that was my first introduction as a teenager. And then my really investing started for me when I went to MIT and I was studying economics and computer science. And this was during the tech bubble over 20 years ago. And you know, I was working two jobs on campus. I also had a summer job where I had some savings from that job. And I ended up, this was like around late 99, early 2000, I don't recall exactly, finding this tech stock that was written up, and Cisco was supposed to acquire it. And I did almost no research or due diligence, as you internet people call it now. No DD, but so, oh, okay, I read like for an hour, and I put everything I had, which is a couple of $1,000s in the stock. And back then it was pretty hard to pick a stock that what the tech stock that wasn't going straight up, but I managed. That stock like did not go up. And by the way, I checked the price of that stock everywhere. I'm not even going to mention some of the places where on my phone I was looking up the quote. Just, use your imagination, and I'll stop at that. And then right around that time, Warren Buffett came and spoke at Sloan, which is the business school at MIT. And I didn't know much about Buffett, but he was a rich investor, successful. So I went to listen to him speak, and it was really a career-changing experience, because here was this guy talking about long-term intrinsic value, competitive advantage, predictable businesses. Immediately made me realize that what I was doing up until that point was not really investing; it was speculating. And I stopped and I started reading everything I could about value investing. Um, After that, I was very lucky that for some strange reason, Fidelity Investments hired me as an equity research associate right out of undergrad. And I say strange because I didn't have a typical background. I had a double major in computer science and economics. I didn't really have a ton of investing experience. So I was kind of like not their typical candidate. There was 3,000 resumes and 7 people got accepted. So I got lucky, and not because of Fidelity being a large firm, but because I had a great mentor there, a gentleman by the name of Joel Tillinghast, who managed a low price stock fund, who's just a terrific value investor. And I was very lucky early in my career to learn from him for those 3 years that I was at Fidelity. And that really put me on the direction to continue to learn and improve as a value investor. So let me pause, see where you want to go with. That's kind of how I got started in investing.
You mentioned that you had Joel as a mentor, and I believe, and I've already mentioned it, but I believe that having a mentor is really important,
Right.
especially at right at the beginning of your apprenticeship or your journey as an investor. How has he influenced you, and how much would it be your life, your style, your method, your way of investing? Would it be different if it weren't for him?
It's he influenced me a lot. I think it's one thing to have like an idol who's a famous person that you don't know, like Warren Buffett, right? You can read a lot about him and read stuff by him, but it's no, it's still very different. I think you and I have talked in the past during our internship about the long feedback loop in investing, right? Where you have, the process and outcome are only loosely connected in the short term, actually very almost not at all, maybe loosely connected in intermediate term, and the connection really happens in the long term, right? And so I think that it's hard to learn as an investor unless you have someone giving you feedback on your process. I always like to compare that to like hammering in nails, where if you're hammering a nail, if you're not good at it, you're going to have bloody fingers pretty soon, and you're going to start doing something different, or you're going to hire someone to do the nails for you. But in investing, you could be doing terrible things, but in the short term, the market might be rewarding that, and you might think, "Oh, I'm a genius." Which is, by the way, why I was so lucky that that tech stock I mentioned didn't go up, because I would have learned the wrong lesson. So, and that would have been like, oh, I don't need value investing. I mean, I'm an MIT student. I can pick tech stocks, right? Which is ridiculous, but it is. That's kind of how I thought at the time. So, I mean, I think that the influence that Joel had on me was to give me that feedback, and also to have a real observation of how he actually does what he does. And probably the one thing I would say that had the biggest long-term impact on me is to search for predictable businesses that are increasing in value over time, that are generating free cash flow in healthy amounts, and that have returns on capital in excess of cost of capital. So, um, and at first, like that wasn't that seems obvious to me now. That kind of what you want, but it wasn't obvious. It's not obvious if you're starting out because you know, as a value investor, which is by the way a very small percentage of people are actually value investors or aspiring value investors, but as a value investor, the first thing you're taught to look for is cheapness, right? Because it's the most measurable. It's very easy to say something has a price to earnings ratio of 7 or 10 or 5, or price to book ratio. So it's the thing that's the most observable characteristic is that ratio. And so that's that's how other people invested at Fidelity. There were very few value investors. Most people were kind of some kind of version of momentum or earnings revisions or something. But the few people who kind of were, there was a gentleman who managed the value fund back in those days. I'm not going to mention the name, but this is what shocked me. This person started investing when I was born, the year I was born. And so he's been investing for over 20 years by the time I joined. He, had a chance to work alongside Peter Lynch and Johnson, the famous Fidelity investors, and he was running the value fund, but his record wasn't good. And he worked hard. He wasn't lazy, and so there were these. By the way, he was a good guy. He was a mentor in a different way, in the sense that he helped me understand how to interview a management team or how to build a model. And I remember traveling with this gentleman who wants to visit the company, and him telling me, Gary, stop it. We don't buy businesses here. We buy stocks. And I kind of paused. Well, Joel buys businesses, and the gentleman kind of paused. Said, okay, you're right, but he's probably the only one. The rest of us just buy stocks. And what he meant by that is, forget about what the business is worth. Look, you know, if they're going to earn 25 cents next quarter, the market is going to assume the annual run rate is $1, and they're going to put 15 times earnings on it. And if the stock right now is at $10, it's going to go from 10 to 15. Doesn't matter if that dollar is sustainable. Doesn't matter if it's worth 15. That's just be practical, Gary. Just go from, figure out how the market is going to price the stock, and then do that. What I didn't say, because I didn't want to offend them, but what I thought is like, well, Joel is the only one who's buying businesses here. That's not exactly true. There was Will Danoff there does it as well from a growth perspective, but that's a different conversation. But he's also one of the only ones with like a market beating record over the time. So like I mean, and this guy, other gentleman who worked super hard. He had these yellow legal pads with paper models. He was old school on companies. You think spreadsheets are tough? Well, try doing a legal pad. If you make a mistake, you have to start over, right? And yet he wasn't beating the market. By the way, with Fidelity's resources. I'm not talking about 1 year. I'm talking about like a 10-year. His 10-year record was negative excess return, right? So I think that those have experiences where, and by the way, to this day, if you look at Fidelity, there's a very small number of portfolio managers who have beaten the market there. Which, by the way, is if you think about it, you have almost unlimited resources. You have IT, travel budget, access to management, everything. And by the way, I started in 2001, and that's the year where in the U.S. Regulation FD came into force, which is fair disclosure, which means that companies cannot selectively disclose material information. Which, to all of you listening, is probably obvious, right? Like, how could a company tell Gary, the Fidelity analyst, what's going to happen next quarter, but not put out the same information publicly for the investors? But up until 2001, that was perfectly fine. And Fidelity, they just say that they had no problems using that. They would call up companies through their access, one of the largest potential shareholders or actual shareholders, and the first question would be like, "Hey, how's the quarter going?" Right? And it's like, so my point is, with that advantage, with the staff, with everything, with good intent and hard work, he didn't beat the market.
What was missing?
And I think what's missing was the right framework and the right investment approach. So it wasn't about hard work or resources, which is funny. So Silver Ring Value Partners is essentially a one-person operation. I have some interns, and thank you for your help. But it's basically me, and it's always going to be basically me. And I might have some junior analyst or two working for me in the future with scale, but I'm always going to make the final decisions and the key judgments. And that's kind of how I want it for various reasons we don't have to get into. But the point is, compare that to this giant organization with armies of analysts and all of this, money to spend, and you would think that it should be hands down, a large organization having all their excess returns, but it's not. And it has to do with the mental models, with the framework of what you're trying to do. And you have to play a game that's winnable. Like figuring out how other people will price securities in the short term is it just from vast majority of us not a winnable game. You cannot beat it. And now there may be someone who can do it legally, and there, a long time ago, people would, give out a famous hedge fund manager as a counter example, and I would say that, and he had to leave the industry for quite a long time because of insider trading issues, and he's back now. But the point is, cleanly, without going into the gray, meaning without getting, like the game of what will happen in the next 3 to 6 months, 3 to 12 months to the stock as a function of the next few data points. That's the game, by the way, that most people are playing. That game is almost unbeatable. Uh, and if you're listening to this, it's definitely unbeatable for you, because if you were winning at this game, you wouldn't be listening to this. So like there's some 10 guys in the world who can beat at that game, and or maybe it's now some quant shops that are using D Shaw or whatever Simon's
Hmm.
Renaissance. Maybe they figure out how to beat that game, and maybe they know us better than we know ourselves. But for most of us, that game is unbeatable, and yet that's the where most effort is being spent. So I think what Joel did is he just tried to think about, first of all, he tried to reduce the universe to above average businesses, or actually he put it differently. He tried to eliminate the bottom thirds of all businesses, and say, look, no matter how cheap these are, they're just too unpredictable. I'm going to get rid of them. And then among the rest, try to find decent businesses run by honest people with good free cash flow, good returns, and think about the long term. Like, what does this business look like in 5 years, right? In 10 years? Doesn't have to be precise, but if you can find a big gap between market expectations for that and what your view is, then that's your margin of safety, and then that's you invest based on that, and you track your thesis. And if you're right, over time, the price and value will converge. The problem is for most people, they're impatient. I'm impatient. We're all impatient. The difference in between me and the average kind of person who's struggling out there is I've harnessed my impatience. I practice bonsai as a hobby, that little trees in the pot. You know, when we're done, I'm probably gonna go finish working on my azalea downstairs. Like I'm pruning. I want the outcome right now. I want to see what happens, because when I prune it a certain way, certain things have to. I expect it to happen. Well, I don't want to wait 2 months to see if I did it right. I want to see it. I want to have it happen now, right? But you have to learn to harness that and say, things. There's a season to these things. So, just because you bought a stock on a very well thought out thesis doesn't mean it has to go up. It might go down. Most of my stocks I buy, their first destination is lower. You might ask, like, why not wait? Well, if I knew for sure it would be lower, I would of course wait, but you don't. But anyway, so
Well,
yeah, so I think that's very important. Is thinking about predictable businesses, thinking long term, and thinking what's the business worth, not thinking about where some other market participant will price that stock in the short term.
there's a lot of people, some that you mentioned, that never really learned, and I don't want to be, I'm liking the word, but I don't want to be condescending or pretending that there's a right way and a wrong way. There's all shades of gray, but how did you or did you find your way right at the beginning, or did you find other ways and then
you realize that you were wrong, that wasn't the proper way to look at things, and then you shift course corrected. I know that it's a life investing is a lifelong journey, and you're still learning. We all are. But at the beginning, did you get it at the first one, at the first try?
No, because I think I was really attracted to the cheap stocks as well. Um, and I think it takes a certain analytical sophistication to understand what makes a business good or not, or why some businesses are better than others. But it doesn't take much sophistication to compare price to earnings ratios. But I do remember one time when I came into my queue and Joel had left me a note on my desk where basically, he had listed all my stocks. So Fidelity, each analyst followed 10 to 20 stocks, rated, and you're supposed to rate them between 1 and 5. One being a strong buy, two a buy, three hold, four sell, five strong sell. And he put my my tickers, my ratings, and then next to each he put ROE, return on equity, right? And it was very clear to me from that moment that I was giving the highest buy ratings to companies that were some of the lowest return on equity businesses, but they were cheap. And I ran into Joel's office saying, "Wait a second, but we are value investors. Doesn't price matter and all that?" And he, unlike me, he's a man of very few words. He was like reading some 10K. He was, he looked up. He's like, and he went back. So he wasn't the mentoring. To come back to that for a second, it wasn't that he gave me long speeches and lectures. It was that, like, that nudge. Because, look, I was very passionate. I am very passionate about investing, but it definitely was. And I was trying to learn everything I could. So that nudge was all I needed, because that made me think, like, well, okay, am I right? Am I wrong? And then introspection, like seeing some of these companies. I always think of a company where one of the, there was a company called Faro. The ticker was FOE, and I used to think, 20 some years ago, that the middle of the cycle normalized earnings should be around $2.50. The stock was in the low 20s, so I thought I was buying it for a single digit price to earnings ratio, and that was my thesis basically. And turned out that they earned in the middle of the next cycle 25 cents. Like, that's just humbling, right? So, like, and you say, okay, well, how can that be? How was I off by a factor of 10? Because, like, here all these analysts are sweating in nickel, 5 cents here or there on the earnings estimate. Like, oh, I have 5% above consensus, 5 cents above consensus. Like, yeah, that's just random noise. There's no way to be that precise. So I was off by a factor of 10, and I had all the Fidelity resources. I visited the company. I met with the CEO, CFO, division heads. It's
What
which
happened then?
businesses. Yeah, it's picking the business. Oh, well, what happened was it was a more fragile business than I gave it credit for. An adverse shock came. The energy prices went up, and that was one of the main inputs. And because the business wasn't good enough, they weren't able to pass it through, and their margins were squeezed. But how do you put that in the model? You can't predict the shock, because if you can predict oil prices, you can make a lot of money doing other things. But you can see that this is a weak business, meaning that you can do value chain analysis and say, okay, it buys from large suppliers, it sells to ultimately large customers. So in the value chain, it's one of the weaker links. And you can think through that if there is any adverse change, that's they're going to get hurt. There is downside variance to the business. Like, really good, it's hard for really good things to happen to it, but it's easy for bad things to happen to it. Meaning that, like, say, if energy prices had fallen, they would have benefited for 6 months before customers would extract if not less, they would extract the economics to themselves. But when the energy prices went up, then they got squeezed permanently, right? So anyway, I think, like, that just example, and just watching Joel operate, and it's like, really is like the turtle and the hare kind of parable. Like, in any given year, what Joel does doesn't seem that exciting. He buys, not boring, but kind of mature, established companies that there's not for the most part, some rapid change or some S curve that's moving rapidly. But then he was Morningstar Manager of the Year in the U.S. And Morningstar Manager of the Decade like of the decade, because in any given year he's never going to have the highest returns with that approach, but he takes very low risk because he pays low prices for good businesses run by honest people, and over the long time that accumulates. And that's, for the people listening, the point, like investing is a long-term endeavor, so you shouldn't care all that much what next year brings or the next 2 years. You're trying to compound your capital safely over the long term, and what you should care is how do you maximize the chance of accomplishing that. And it's not by guessing quarterly earnings or figuring out who, picking the fastest growing companies or the cheapest companies. It's by focusing on a few insights where you understand the business and the market is completely pricing it differently from what the intrinsic value is.
I wanted to get into your process because it's probably the most complete and well thought process I've seen so far. But prior to that, I wanted to understand how you got there, how you got to your owner's manual. I'm not sure if it's available, freely available for everyone.
Yeah, I will share. If you send me an email, and you feel free to put my. Actually, yeah, I'll give you a link. Rather than emailing, there's a request
Okay.
form that sends me an email. I will. You can put that link if you want, and anyone who requests it, I'll be happy to send it to them. I get a lot of students or anything like that, but I'm happy to share it because. And very quick story: when I started doing it, my mother said, "Why are you giving away your secret sauce? That's your competitive advantage. You shouldn't share this. It should be your proprietary." And that's there's two reasons why. First of all, even if someone exactly studies that whole process, they're not me. The process is tailored to me, which we can talk about in a minute. But also, it's also about execution. Anyone can talk in general about value investing and whatnot. It's judgment, it's execution, and it's temperament. And temperament really means the ability to stay rational when crazy things are happening, and when you have a lot of pressures on you to act in ways that's not rational, right? But sorry, continue, please.
I have a podcast or a weekly podcast with two friends, and I bring up your name a lot of times. People might be fed up with me talking about you right now. And one thing that I always say is that your owner's manual could be a book in itself, right, and be sold because it has a lot of knowledge right there, distilled a lot of knowledge gained throughout the years, distilled in one very clear and well thought manner, and it has helped me a lot. A lot of the time I go back to it, as we've mentioned previously, or you've mentioned that sometimes you go back to security analysis. I go back
Hmm.
to your owner's manual. So it's for anyone that's listening and likes this, and if you've been listening, it's because you liked. I highly recommend reading it. The thing is, it's so well thought. Did you stop one day and thought, let me put it in writing? Was it, how long did it take you? How was it, that
Well,
process?
sorry, you froze there for a second. Are you still there?
Yeah, I'm still here, and you froze as well. Can you hear me?
Oh, did I
Hello,
lose you?
I can hear you.
Oh, no, you're there.
Yeah, we're here.
Can you hear? Okay, I think it's on my end. All right, sorry. I heard your question. Did I put it down all in one kind of go, or did I just at one point realize? So I put it down when I started Silver Ring Value Partners, about 5 years ago. But I think the process was evolving over time, and I managed a value fund at my prior firm called the Focus Value Strategy, where I was using basically this. I mean, parts of the owner's manual have to do with more like how I've set up the firm and the kind of the what my commitment to what the relationship should be between me and my partners and so forth. But a lot of it is just an investment process. And so I think that it's important to do two things. One is it's important to write down your process because for a few reasons. One is it helps debias you from behavioral biases. So one of the things I always do in my quarterly letters to partners is I write exactly how did I implement the process, and they have a chance to observe, am I sticking to what I've said I was going to do? And so again, it's shifting the focus away from short-term outputs, which are random or near random, to inputs, which are things that we can control. And also, it's like, if you remember the story of Odysseus and the sirens, it's tying myself to the mast of the ship. So if is a temptation to do something else, something crazy, which we all get, maybe you don't, but most people do, there is this filter of, okay, is it in my process? And when I tell my partners in my core letter that I did this, are they going to be able to see that it is consistent with the process? So it helps me, not even think about crazy stuff, because a lot of times people just, do and they say, oh, I don't need to write it down. I know what my process is. I can, and then they deviate because they can't even tell if they're deviating. No, and other people, because I have a lot of friends when they're running their hedge funds, they disclose very little about what they're doing. Like, oh, it's proprietary. Yeah, I'm sure it's super proprietary, right? But I mean, maybe it is proprietary. But let's say it is, because some of them are very good. And let's say it is proprietary. But okay, you can disclose it with some lag time. You can disclose it, 3 months, 6 months, when it's no longer, But like, I think hiding behind proprietary sometimes is a fig leaf that you don't really have a well-defined process. So also, so I think establish expectations for you, and also allows you to evolve, because I don't think your process should be permanent. It's okay to change things, but change should be slow, assuming you have a well-established process, and change should be not based on a desire for one specific investment, like, to fit it in, because then that's just being undisciplined. Change should be from first principles thinking. Okay, you're thinking about, something, you say, well, my current process doesn't address this very well, or hey, there's a better way of doing it. So it's okay to change it. So in some of my letters to partners, I said, okay, I've added, for instance, using options in certain ways that I think is consistent with intrinsic value approach. That wasn't in the owner's manual. And I've explained, I had like a addendum essentially in one of my quarterly letters. But I think it's important to make changes to your process that are not because you're trying to squeeze some particular security in and you really want to do it. So you buy the security and say, oh, I changed my process, it's fine. First, change your process from first principles. Let people know you've changed your process, and then apply the new improved process. So I think the long and the short of it is, I spent 15 years at large firms prior to starting Silver Ring. So I already had a well-established process. I wrote it down 5 years ago, and now it's kind of gradually evolving, and that's about the right pace. 20 years into it, there shouldn't be drastic changes, I don't think, for most people. Never say never.
Let's talk. Let's stop talking about it and let's dive in. Your process, in my view, and correct me if I'm wrong, is all about minimizing error. And you've said several times that you're not looking for that one idea that will change your financial life, but you're looking for a repeatable process.
Mm-hmm.
Walk us through your process and uh, how you come up with it, and if this idea that it's all about minimizing error is true or not.
So, I mean, there's a number of parts of the process, but I think that the the three stages, right, of the investment process itself is, how do you find ideas? What do you do with a potential investment candidate idea once you found it, decide if it's worth investing in, and then how do you manage the portfolio? Those are probably the three big parts, and I have YouTube videos that are more in depth on each of those parts. So I'm going to be brief, and certainly feel free to refer to those. But I think, the idea generation aspect is, I want to have multiple streams of inputs, because I think sometimes people get their ideas from just one kind of source, say screening, and that keeps out a lot of ideas. So I have four sources of ideas. I have, screens that I use, and usually what I look for in screens is decent free cash flow, decent returns on capital, and then low 7-year free cash flow yield. Because that 7-year free cash flow yield really gets rid of a lot of junk, frauds, and so forth. You miss some things, but if you have
Do you average the 7 years? Is that it? That you?
I do. I mean, if you actually want to know the specifics, I average and then I multiply by 1.25, because the idea is I'm trying to make it comparable to kind of a forward 12-month free cash flow. So if you have the last 7 years, and most businesses that I'm looking at are growing at some moderate rate, I'm basically moving into the duration is like 3.5 years in the past of that 7-year average. So I'm moving it, you know, into 4 years, 5 years forward, basically, to forward 12 months. But that doesn't matter. You can do it either way. The point is, by looking at some kind of a rolling multi-year period of free cash flow, you're getting rid of companies that are not generating cash flow. They're not. They're frauds. They are just too expensive. And so what's left is companies that I kind of like to invest in. Not all of them, but some of them. And typically, the number where I start getting interested in is 5 or higher for free cash flow yield. So if I'm paying $1, I want to make sure that I'm getting at least 5 cents of free cash flow. Right now, five is the minimum, and that would be for like a pretty darn good business. But typically, it's I'm getting a much higher free cash flow yield now. But it's a good way to screen and sort the universe once I already kind of establish that it's a decent business, has decent returns, and so forth. I also look at special situations, so spin-offs, post-bankruptcies, various reorganizations, and those don't screen well. And that's the whole point of adding them as a separate stream. I also look at an inventory of good companies that I watch, kind of a watch list that I watch for dislocations. And finally, I have a network of value investing friends, and I also look at filings of value investors I respect as an independent stream of ideas, because not because I'm going to blindly copy someone who's buying something, but because if I know that they have a compatible investment process, there's a good chance that it's worth looking at for me. So those are the 4 streams. I process it, and I prioritize the highest likelihood candidates. I usually work at 2 or 3 at a time, and that's where my interns, again, thank you for your help in the past. I sometimes have them gather data, try to prepare things where as I'm reading the annual reports and trying to understand the business qualitatively. The 5-step research process, which is what I do with actual candidates once I decide to work on them. First I assess quality, and that's a function of business quality, people quality, and balance sheet quality. I then assess key economic variables and figure out what are the few things, 3-4 things I really want to know about this business over the next 5 to 10 years. And I come up with a range for each variable. In the next step 3, I value the business in a range. Value is usually in a range. We don't know the future precisely, but we can put an estimate on the kind of confidence interval, if you will, worst to best, with the base case as most likely. So that basically, step 3 is modeling that. Step 4 is valuing that, and I usually use a discounted cash flow approach there. And step 5 is my behavioral checklist, because I do believe that we are frequently biased. I'm biased. Almost everyone, I think everyone is biased to some degree. And I'm not talking about bias like bias against people. I'm talking about anchoring, confirmation bias, various things that we all know, fear of missing out. So I'm trying to go through a checklist to see like which ones of these apply, how do I minimize them? And then that gets me, my intrinsic value range and assessment of the quality of the business. And then in terms of constructing the portfolio, it is about loss minimization, but you don't want to take that too far, because if you can minimize loss by buying, inflation protected bonds, but then you also don't get any gains, right? So there is some trade-off. And what you're trying to do is make sure that at the portfolio level, the probability of large loss is extremely low. Which doesn't mean, and there's different styles. Some value investors insist that every security has to have extremely low probability of loss. I don't. And the reason I don't is, you might have a situation where, the upside is 3 or 4 times, and the downside is 100%. And let's say you think it's 50-50. Well, that's a huge expected value, right? If you flip a coin and heads, you get 300, and tails you lose 100. That's very nice expected return, right? So I think that you don't want to exclude that, but then you have to think very hard at the portfolio level that you have different kind of things making up your portfolio, so that if you do lose 100%, 15% investment, that's completely unrelated to anything else that's going on, right? What you don't want to have is, I think, either one investment or a group of investments that are correlated, where if you are wrong on one judgment, you end up losing. In my case, I set the threshold at 10%. I don't want to lose 10% on any one decision. And the reason is, if you lose, say, 5%, to go from 95 back to 100 is something like 5.5% or whatever, right? Or if you go from no 100 to 90, to go from 90 to 100 is 11% return. So the rest of the portfolio can overcome that in a reasonable year. But if you go from, I don't know, 100 to 80, so you lost 20%. To go from 80 to 100 is 25%, and that's a lot of money. Not even a lot of money. It's a high percentage, and certainly won't happen in a typical year. So I think that my goal is to minimize the chances of large losses at the portfolio level, and then have a very attractive expected return. So I typically buy investments for about 2/3 of what I think they're worth, and I'm willing to have maybe so for something that's a really good business, maybe 70%, 75% of value is fine as the bare minimum. But something that's a good but not great business, 65% of value. And for average businesses, which is where I stop, I don't go below, I usually get close to half, 50%. And I think there's that trade-off between the qualitative margin of safety and the discount to intrinsic value, where I'm trying to make sure that if I'm going to buy a business only average, I'm getting that much more margin of safety from the price. Anyway, that was a lot. I have videos and all of this. It's in the owner's manual. I'm not gonna otherwise this video is going to be 3 hours long and no one's going to listen.
No. I'm loving it, and I think several of our viewers will love it as well. The other day I was looking deep inside into that. You translate all the qualitative aspects into numbers, or into to get a quality range from 1 to 5, if I'm not mistaken. And I was comparing that, and I don't want to compare or talk about other investors. I was comparing that with Ensemble Capital way of doing things. It's not that different, that translation of qualitative factors into numbers. But then what informs the weight of your positions is the downside, or the amount of downside there is, whereas they think about the upside. And I was thinking, what if, and you don't mention this on your owner's manual, what if you make a large, find a quality company, make it a large position, let's say a 15% position, and it goes up in value, not in price, or in price as well, and you recognize that value going up. At what point do you cut it? At what point, even if you still feel that it's undervalued, if it gets to 80% of your portfolio, at what point do you cut it? I know this is a theoretical exercise, but
Well, I mean, I think I have different cutoffs for different quality businesses, and the readings are approximate, right? There's no way to map qualitative to quantitative precisely. It would be foolish to try to do that. But I think it's just bucketizing businesses, and 1 being the highest quality and 5 being the lowest, 3 being average, just giving it kind of a grade, approximate grade, like A, B, C, D, F, something like that. I mean, for the best businesses, I typically wait for 95% of my base case value. For the above average, I wait for 90 to start selling, and for the average, I start at 85. And I usually exit in stages, in thirds. I'm a terrible seller. I always sell too early, and I've tried to fix that. And I think I fixed some of it, not all of it. Because I think when you think about selling too early, the issue usually is that you have not kept up with the value changing, right? That the value is both uncertain, meaning at a point in time, there's a range of possible values, and it's dynamic, it's changing up or down. And those are different things. Uncertainty is like, okay, you freeze the value right now. I'll give you a simple example. Let's say you have a mine gold mine, and you're about to dig and see if there's gold, and you think there's between 20 and 80% chance that there's, you know, $1 of gold in there, right? So that's uncertain. There's a range of possibilities of, whether that, or actually, let's do it differently. You think that there is between 20 and $80 of gold in that mine. You're not sure which, but there's a range of possibilities. That's uncertainty about the value. But then you dig and you find out that there is $75 worth of gold there. Well, that value has changed now, right? Sorry, that certainty got realized, but then that company says, well, we found a new mine, and that mine also has between 20 and $80 worth of gold in it, right? Now that's different. The first was uncertainty. The uncertainty maybe got realized between 20 and 80. Okay, 75. Now we know that mine is worth 75. But when we were thinking about the original range, we didn't even consider that there was a possibility of a second mine. Now that we know there is not, the value is higher, right? And so the key, I think, is to make sure that, because I think when value investors value stocks, a lot of times they're overly conservative. And I think I'm not immune from that, because I think that the logic is something like this. Look, why push the envelope on valuation when I can justify buying this without, making the assumptions more aggressive, right? Like, hey, why push the envelope? Well, what happens then is it reaches some sell point and then you sell. But there's two things. One is you could have been too conservative to begin with, and that's not a good thing necessarily. It's better than being too aggressive, but it's better to be approximately right. And the other thing is you fixated on this fixed value. And the reason you did is because you were taught that to be a value investor, you need to be very price disciplined. You should be, because the sell side, frequently just raises price targets as the stock goes up, and it becomes a pointless exercise, right? But so I think young value investors react to that lack of discipline by saying, well, I'm not going to keep moving my target as the price appreciates, because that's being undisciplined. But what you should be doing is really reassessing the value without looking at the price as much as possible. And what I've done is I have this thesis tracker where I track the investment thesis for each of my companies. And if, and every quarter I color code the box for the company, green to red and shades in between, based on, did the results come in better or worse than my base case, with no excuses. Doesn't matter if it was a one-time charge. And the whole point is to debias and say, okay, this is bright green. Okay, this company is doing much better than expected. That puts a stop on me selling and forces me to revalue it first. Well, conversely, if it's bright red, also, the other mistake that value investors, so they sell winners too soon and losers too late, right? That's the double whammy. The other purpose of the thesis tracker is, okay, well, it's bright red, and but the stock is down, but it's now cheaper, so I'm holding on. A lot of times, young value investors or inexperienced value investors will buy more, right? Sometimes that is the right move.
Not only inexperienced investors,
but only. And I think the trick is you have to separate how much is transient, how much is that's the art, right? Investing is art and craft. Craft is, okay, how do you set up a DCF? A monkey can do it. I can teach anyone to set up a DCF. The art is judgment. How do you process information? How do you judge people, judge businesses? That's the art, right? And so you have to say, okay, there was a really bad result. Is it completely temporary? Is it completely indicative of a lower value, or somewhere in the middle? That's why one of the reasons investing is hard. It's like you don't know the answer. So I think you have to adjust the value up or down, but proportion. It's kind of Bayesian updating. You don't want to take one piece of evidence, which is probably what the market does. The market participants usually take the last few data points and over extrapolate them up or down. So if the last few results were good, they assume the future is very bright. The last few results were bad, they assume the future is very bleak. Usually to a degree that's not fully warranted by the facts. And that's where the opportunity is for you and me.
You've mentioned previously that the hardest thing for you was to sell, and not only that, but also, and I think you were mentioning you're selling too early, and you should improve that part. And that how good? And the question was how good are you in updating the value of something that whose values is going up? I believe. Is that still on your mind? Is that what concerns you most about your process right now, or what is it that you want to improve more than anything else?
I think the area of improvement is just being a better business analyst, right? And better company analyst. I think beyond a certain point, you shouldn't be getting better at like crunching DCFs. That's the basics. You kind of have to master that. That's is what it is. I think judging businesses and mistakes of omission is something I struggle with a lot. Like I missed a lot of good companies that ended up being far better than I thought they would be. And so the question is, I always try to figure out is how much was knowable. Some of it could be just unknowable, like lottery ticket. You don't know who, just because someone won the lottery doesn't mean you could have predicted who won the lottery. But some of it could be knowable. So I constantly question myself. Okay, am I being too conservative and passing on companies? Um, I mean, or conversely, you know, I think I think the trade-off between quality and price is always the most challenging. And so the better you get at assessing quality correctly, the more you can afford to pay a little bit more. Up to a point, I'm just not going to pay fancy prices because even though there are styles where that works, it's not an incorrect style. It just requires a lot of judgment about the future that I'm unwilling to bet that I have. But I think within the range, if you are better at analyzing the people and the business, you can afford to pay a little bit more and still have a good bargain. While as if all you can do is crunch historical returns, ROEs, this, and then run a DCF, you can't afford to do that. So I think just business judgment and thinking about mistake. I mean, maybe it's the nature of the market we're in. It's been a long stretch of upward market, so a lot of things have gone up. So maybe it's natural to. I'm asking myself like, how much, which ones of these should have also have bought. But I also think in general, really good businesses run by good people are rare, and so I constantly question myself, how much of that can I incorporate versus how much is just permanently outside my circle of competence because I'm just uncomfortable with the loss potential of something that's expensive but good. And if I'm wrong about how good it is, then I lose a lot of money.
Mhm. The other day, I asked a few friends if they had any questions for you, and one of the questions was because you sell in a staggered way, if
Hmm.
you also buy it in a staggered way, if you have that starter's position while you're doing due diligence, or if you buy it, the whole position at once. How is that?
It's a good question. I don't buy intentionally in a staggered way, but I think the way it ends up, like I very rarely, as a matter of fact, it's a good question to look at it empirically. I can't recall a time where I went from like 0 to a 15. So my position size is a 5 for small, 10 for medium, and 15 for large. And I don't recall a time where I went from 0 to 15 ever, like right away. Uh, but I don't like for my 5% positions. It's not like I go and say I'm going to buy 1.5, then 2, then another 1.5. I don't do that. You might say, why not? I I just don't. I think that in the competitive market, if I see something that fits my quality and price criteria, and I want to add to the portfolio, I should just do it. Like because who knows? It might not be available in a month, right? Prices might have changed, and I might, then I'm stuck with a stub position. I also don't think that I'm as guilty of buying early on a long-term basis sometimes, but I don't think it's as big a mistake that I make. Versus I've know the selling in stages is really an attempt to slow myself down, give myself chance to reevaluate rather than having this whole bright line test. Okay, it reaches this price, I need to get out of it right away. Which, by the way, one thing that might help you is, and help me, is if rather than thinking in terms of price to value ratios, think in IRRs. to invert that, because when you, like in my head, when it goes from to 100% of value, now it's fully overvalued. It's a switch.
0%. Hmm.
Yeah, right. So instead, what you should be thinking about, okay, before it was offering 9.8%, sorry, 10.2% returns. Now it's offering 10% returns, right? So if you're doing discounted cash flow at 10%, something is fully valued, it means it's offering you your discount rate, 10%. And maybe if I'm buying something at, 60% of the value, it's by offering me 14, 15%, annualized rates of return if I never sell, right? Okay. So when it goes to 100, it feels like it's a bright switch. It's overvalued, and I'm a value investor. I don't own overvalued things. But looking at IRRs, looking at it going from 10.2 to 10.1 to 10 to 9.9 to 9.8, it's a very analog change. There's no switch, right? Now, and so like the mistake of holding on a little bit too long to a good business, probably on average, very, very low. The business is growing in value anyway, right? So if you think about a cash flow stream when you value it at 10% discount rate, that means every year the value should be 10% higher, right? Before dividends. Meaning that if you wait a quarter to sell something, it'll be 2.5%, all else equal, it'll be 2.5% more valuable, right? So I think that rushing to sell, I think, is a pretty, because I think it's systematic and it happens every single time. It's like if you were to go to an ATM and every time someone took 10% of your money that you're taking out, right? Like you actually have 10% less money, right? So, if every time you go to the ATM, someone takes 10% off. So if every time you leave 10% on the table that's gettable while maintaining a margin of safety, and that's key. I'm not talking about chasing speculative returns. I'm talking about staying within that zone where there's still margin of safety. Maybe not as great as it was at the beginning, but certainly it's still not nothing either. I think that's easy money, and so I don't do it in stages. I rarely. I think my initial position is typically 5%. I think maybe occasionally I've gone to 10%, but that probably is with a company I've known for a while. But if I'm working on a completely new company, I would say very frequently, if I do invest, it will be 5%.
But when do you switch to 10 or to 15?
So I think that it's possible to start with 10 or 15 in theory, right? So I have my thresholds. Let's say it's a great business and it's trading at 65% or lower of intrinsic value. That's a candidate for a large position. It could be 15%. It's very unlikely that I get there that it just shows up like that. I think that chances are maybe it shows up at 75% of value. So maybe I make it a 5 or 10% position, and it goes down more. And then I, on some developments where I feel the price to value gap is widening. And so that's usually when I'm adding to it. And I think there's an important point there for your listeners, which is people usually think like, okay, you make an investment, that's it. Like an investment is actually a whole series of main decisions. As you basically, information comes out, and you at each stage are making a decision to do nothing, add or reduce the position, right? And it's a series of these decisions that ultimately determines your success on that investment. You might, let's say you bought Amazon, and then you sold it after a double. Okay, good, but you missed like the other 99 bagger portion of Amazon, right? And I'll give you another example. Like my old firm, in one of the funds, the person who runs the team owned Amazon from the beginning almost, and it was their number one position from the beginning, like for many years. So your intuition should be that if someone bought Amazon and has gone up so many times, this person should have an amazing record. Well, they don't. How come? Well, because they kept trimming Amazon, right? I'm not saying they shouldn't have, but my point is they made a series of decisions where Amazon would be a 5% position, would get to 8, they would reduce it to 5, it would go to 8, they would reduce to 5. So they actually, as a result, if you look at how much money they made in Amazon, it is a fraction of what they could have made if they just held on. Now, holding on is hard because when you have one big winner like that, that's going to become half of your portfolio or something like that. And so, how do you deal with that? That's a separate question. The point is, it's not. You can actually even make a bad initial decision, but if you keep making good decisions, you can overcome that. So I think that that's going back to your point of making your process be the thing that's going to give you success as opposed to one decision. Focusing on a repeatable process, like don't. So you make a mistake. Okay, you made a mistake. I mean, how big of a mistake is it? Now, if you bought a fraud, if you bought a company that's over levered that goes bankrupt, that can be a big mistake. So that's where getting rid of or minimizing the chances of those big mistakes is really important. But let's say you buy a good business. You thought you were buying at 65% of value. You were a bit off on the value. You were buying at 85% of value. That seems like a big mistake. You wouldn't have bought it at 85. Is that really a huge mistake? It isn't. It's not something you would have done, but you shouldn't lose money over time, right? With that, you just might earn a subpar return. So I just think that if you pick your universe right and avoid things that could be huge losers, then I think investing will be more forgiving to you. The other question is, kind of how do you increase the position size? I think some of it is just getting to know the company and the people better, right? So passage of time, following the thesis. I basically don't trust myself fully on a company I've never heard of. With people, never say never. There's nothing in my rules that says I can't start with a large position, but I think typically I would like to get more familiar with it at a 5 or 10% level, because the 15% they're rare and they're meant to be like complete out, like really outstanding. At any given time, I shouldn't have more than 2, 3 of those. Well, almost by definition, if you have like 10 of those, you have 150% of your portfolio, right? Just mathematically. But I think in general, like I think concentration is an individual choice, and it's also a function of your investment style. Maybe a topic for another day, but I think in general, you kind of don't want to have really big positions on things that don't check most of the boxes, if not all of the boxes. And that's just not going to happen most of the time.
You have, I don't want to get into the specific stocks, but you have 3 stocks connected to John Malone. Is there any story behind that, or was just the coincidence?
It's a good question. I thought about that myself. Now, there's a risk factor. So you have to think about what degree does having Malone as kind of the key investor, the chairman, or the power behind the capital allocation strategy, how much does that correlate their outcomes? I think part of it is an accident. Part of it is, maybe the company I keep. I have a good friend in the investment business who invests mostly in John Malone, and I think over time he rubbed off on me a little bit. But I think the ones that got added, I had one, and then there were 2 special situations with 2 others where there was basically a really big price dislocation. And so I think Malone is known for various financial engineering things, and so there were a couple of situations where the price to value gap just blew out really wide, and I basically couldn't resist after doing the work. And I also think he's a good capital allocator. I think that he does use leverage appropriately. I think that there's a lot of things that he does well. I don't necessarily. I'm not.
Did
I'm
you
not
say he doesn't use, or he does use?
He does.
Okay.
He does. He uses leverage appropriately, which is rare in the public markets. Right? There are all these CEOs running around saying, "Oh, I'm over 2 times debt to EBITDA. I'm gonna reduce debt." Whereas Malone is very comfortable with a more appropriate level of debt for the right business. So I think also Malone's companies tend to be high free cash flow businesses. They tend to have predictable economics. So I think between my respect for his capital allocation and the fact that the nature of the businesses he's involved with matches the kind of the predictability criteria that I look for. That's part of it. I'm not John Malone groupie. I'm not, or Warren Buffett. I respect many people or a number of people, but I mean, 5 years from now, I might have none of these, no John Malone companies.
Mhm.
It's also a tough market to find new ideas in. There's not a ton of mispricings of quality businesses that I can find, and so when something comes along that fits the price and quality criteria, I'm not too worried about John Malone being the correlating factor because the businesses themselves are different enough that
Mhm.
even if, God forbid, something were to happen to Dr. Malone, I think the businesses would do fine on their own.
I still have a couple of questions for you, and
Sure.
because a lot of I believe that a lot of people that are listening to this and watching this might not be as experienced or might not have too much experience. Um, how did you go through the great financial crisis? And you've mentioned several times, we've talked about this, that people tend to extrapolate recent trends, and a lot of young people, young investors, have never gone through a bear market. I haven't.
Hmm.
So these two questions are tied. How should they prepare, or what advice would you give them? And what did you see? How did you go through the great financial crisis? That, and what have you learned that you can now pass on to the younger crowd?
I would say the first thing, no, so every crisis is different, and in 0809 there was the financial companies that were imploding, and I almost bought Bear Stearns. So I was a co-manager on a large cap value strategy at a prior firm of mine, and as I remember Bill Miller, who was a very well regarded, famous investor, buying more and more financials, and Bill Nygren and Oakmark. A lot of people I respected buying more financials, and I was sitting there analyzing, like, they're so cheap. It's not like how could this be? This is irrational. And then I guess what saved me is I couldn't figure out, like, if things get worse, what happens to them. Like Bill Nygren lost a ton of money in Washington Mutual, um, and this is he made a 15% position, went down. He made a 15% position again, it went down, and like, and so it goes back to, not that I'm smarter than these guys. I'm not. It's just, if I don't understand something fully enough, I just pass, and I pass on a lot of good ideas. Luckily, I passed on that as well. Um, I think that crises provide you with interesting choice, right? It's one of the few times that really high quality businesses go on sale. So one strategy is you could trade up in quality. But the flip side is, when the high quality businesses are on sale, then not as high quality businesses are on an even bigger sale, right? So so there's a opportunity cost element, and I think you probably want some combination of them, assuming that somewhat lower quality businesses are not fragile to a degree they can go under if the crisis is longer or deeper than you expect. That's key. So and I think what really helped me is that was my second downturn. So I started investing in '01 right before the tech bubble burst. And then I remember in my first crisis, it was like literally deer in the headlights. I was watching the S&P to go down 3% a day, and I was guessing where it's going to end, which is ridiculous, right? Like, I remember having conversation in the breakout room with somebody, and I was like, no, it's going to stop at 700. No, at 800. Like, it's like, who the heck knows? Nobody knows, right? Um, so I think but the point is, in the first crisis, that you really didn't act, right? I think that experience taught me that you have to act on your process. The point of your process is to it's like your training. You fall down to your highest level of training, and your process is your training. And so you kind of start executing, as uncomfortable as it feels. And I'm proud that I did that in the financial crisis. I started, we bought a lot of good businesses at good prices, and they recovered eventually. And but it was uncomfortable.
But
Um,
were you previously fully invested? How did you have the cash to do it?
Yeah, no, with that fund, we were mostly fully invested. So some of it was trading businesses that didn't get sold off as much for ones that did. At Silvering, I don't have, that's one of the things that I, never understood about the mutual fund world. I get the reasons why they say they do it, but it doesn't actually make sense. If you're an absolute value investor, you want to have the ability to have as much or as little cash as the opportunity set demands, meaning that if you have zero investments that meet your criteria, you should have zero investments, until, because you can wait for a long time and then, invest and then make uh, enough money on the investment to offset the cost of not having invested for a couple of years. But that's not how many people think. People think, well, if you miss the best days in the market, you're done. They point to some study and they don't understand it. Like, it's true that if all you're doing is timing the market, it's a terrible idea. But if you're waiting for a handful of businesses to come to a huge discount, and when they do, they're going to offer really attractive forward-looking rates of return. You putting a couple of zeros in front of that return stream will still make the total rate of return very attractive, right? Just mathematically. Even putting three zeros, you can have like take last year as an example. I was being able to buy things at like ridiculous prices, like a third of their worth, which is you're never going to get. Now you can't bank on that. Normally, 50% of intrinsic value would be great, but you could have sat in cash for 5 years, bought a bunch of stocks at 30 to 40% what they're worth, and your IRR overall would still be great. Because, right, so I think that the fully invested thing is a marketing thing. It's a business preservation thing, because the thing that mutual fund managers and their overlords, the marketing people, are afraid of the most is underperforming and losing assets, right? And so one source of big underperformance is having cash, right, as the market's going up. So mutual funds are not usually managed with cash; they're managed fully invested. So we did have to sell some of the companies that were more defensive in nature that didn't get sold off as much. Um, but it also taught me a lot about fragility of businesses, and also about confidence I can have my value estimates. I owned a couple of asset management firms, one in particular I recall, that really went down. They kept buying more, went down. And that was a terrible experience because the value was permanently impaired. And taught me that valuing asset management firms is really hard because the asset levels aren't permanent, right? The value can change, and all of a sudden you're going to have, something like, you know, 30-40% decline in value. That's not good, So
Do you feel the
part of
same with holding companies when someone tells you, well, it's at 70% of NAV at net asset value? Okay, but the assets inside it also vary. Their value also vary.
yeah. No, I think that's right. I think that you don't want to get too, the stability of value. So the point of predictable businesses is that their value should not drastically change, right? If you look at let's say, oil-based company, and someone says their net asset value based on their reserves is such and such, that can be drastically different in 6 months. So it's very unstable. An asset manager also, let's say the market goes down 30% and they have outflows, so their assets are down 40%, their profits are probably down 50, 60% because they have fixed costs. Very big change. Now, if that's not permanent, that's fine. But then essentially you're making a bet on the level of the markets being right or wrong. And so you can have a stock towards the top of a market, that an asset manager that looks very cheap. This is what happened in '07. Maybe you're at 8 times, 9 times earnings, and like, oh, it's very cheap, and it's a good business, it has high ROEs, right? High returns on capital for an asset management business typically. The only problem, well, actually, your value is going to come down a lot, and because the market is at an unsustainable level, so you kind of are underwriting the market being at a sustainable level. So I now have trouble. Like I've lost enough money in asset managers that even though they are high return businesses, for the most part, I just stay out of it. To be
Hmm.
honest.
Hmm. One last question for you. And because everyone was stuck at home over the prior year, and many of us are still at home, and I know you have kids, and as investors, we need some more, but and some less, but we need long periods of time undisturbed to research the business that we're researching. How do you do it, or how have you done it with your kids at home, um, to get that precious time alone?
Yeah, I mean, I'm lucky. I have three kids. They're good kids, and I have my home office. I always had my home office, and I had a downtown office. I was working part time on each. I actually haven't been to my downtown office in over a year. I could. I'm just like, why bother with the commute? It's just me. I don't like. There's really no. I still haven't canceled it, so I guess I'm wasting money. But I think I might go there sometimes to really want to focus, and that's what I used to do. Like the days where I want to have a really like long modeling session on some company or studying a company in depth. But I also think that my mind works in spurts. Like I will do something, take a break, do something, take a break, and I'm lucky that we have a great nanny, and so I we're good. I don't have any complaints. Um, occasionally the kids are loud, and so I show my face, and they quiet down, and but I haven't had many problems, and I don't think I think like my productivity hasn't really suffered. So
Okay,
I think I've
great,
been lucky.
great to hear. Gary, I thank you very, very, very much for being here for this conversation. And you're always invited to come in. I hope you come back one day. And thank you very much.
Well, thank you for having me, and thank you for all your help and our friendship over the years.